This is our Forex blog for April 11th, 2011. And like most days, we really want to find currencies that are strong and buy those against the weak ones, and buy and sell the weakest currencies. The real-time strength or weakness is right up here on the top. Anything at or above the dotted white 80 line shows extreme strength. Underneath that, we have the daily, weekly, and monthly trend. The dollar today, the longer-term trend is down, and the weekly, monthly trend of the yen is also down. But they had a counter trend trade, most of today. So if you see some strength coming into a currency, especially if it's extremely weak, you can certainly look for some short-term, 5 to 25 pip moves. But most of the time, if you see the weakness kind of ending and some weakness coming back in later, go back and trade it in the direction of the longer-term trend. Obviously, the yen was significantly stronger than the dollar today. And so, but keep in mind that a weekly and monthly trend is still extremely weak on this currency. Today, the pound shifted from, being longer term trend up to being down after intense weakness Sunday night and earlier today. The yen was the strongest between the two currencies. So earlier today, you would have wanted to look to sell the pound yen. Actually, one of the better trades was on Friday when it broke down underneath the hourly, and again right here. Anytime a currency is up too much, too many days up and down, up or down in a row, it tends to reverse. You can see it broke down underneath the hourly, went down. Here's a counter trend trade. That's not too bad. And when it finally broke these lows, that's not too bad of a trade. It fell about 25 pips, went right to the weekly pivot level. And when a currency is underneath the previous day's low, or previous week's low, or previous month's low, it's a major sign of weakness. So when it came back up and couldn't get above it, that's a decent trade. It didn't really pan out, but let's say you shorted this somewhere around 48 with your stop right above the high. It pulled back down here to 29, so it did pull back about 15 pips. That's more than enough to move your stop to break even. And the currency broke back from underneath above the previous day's low. That's a sign of strength. So when it comes back down, just try to be a little bit careful. And when you go short right here, you can see it also fell. Once the currency breaks back above the previous day's low, and especially the hourly, the longer term trend of this is up. So this is a pretty decent buy. But keep in mind that Friday, Sunday night, and most of today, the trend was down. So if you draw your fibs on this, usually a counter trend move up is going to stop at the first or second fib target. Aggressive traders might have looked to sell up here because of the previous 2.5 day trend. And if you brought up a tick chart of that, you might have drawn your trend line underneath this up bar right here, gone short. You might have got out of that first trade with a 5 or 10 pip loss. It comes up to the second fib target. You wait for signs of it not going up anymore. When it breaks down right here, you go short, and you can see that trade just really smoothly trended down. You might have got out of it right here near the hourly here at 70. That's a 40 pip move. So if you lost 5 or 6 or 7 on the first one, got short again, pretty high probability trade. Also on the tick chart, when it was hovering near its previous day's low and broke down right here, it's pretty easy to see where fib targets are of previous moves. It didn't quite get down to that fib target. There wasn't a whole lot of statistical weakness at the time, and when it started to go back up, you would have got out of that trade with a small 10 pip profit rather than let it turn into a break even or a loss. That was one currency that the currency meter showed to trade. The Australian also had consistent weakness today. Keep in mind the longer term trend is up. So you could have also looked to sell the Australian yen today. You can see Sunday night it broke down underneath the hourly, came back up and couldn't get back above it. That's usually a sign of selling there when a resistance area like the hourly gets hit and it can't go above. So when it breaks down, that's not a bad short. It really didn't pan out too much. You might have made 5 or 10 pips or broke even. And then when this low got broken, it's pretty clear that it doesn't want to go up. So when it breaks down underneath those lows, you might have made 20 pips on that trade. And anytime you see a currency make lower lows, pulls back, there's a 50% pullback of that move. This is a pretty decent trade right here, and it pulled back about 20 pips. Tick charts really clean up the minute-based chart and give you a much more precise entry in most of these cases. For example, let's say you wanted to get short on this counter trend move up. It's always nice to see on a tick chart slightly higher high and the market fails to go higher. When it breaks down right here, you can go short with your stop right above the high. In this case, you're risking 7 to 12 pips. It pulls back, get a little bit of a counter trend move here, and you can always move your initial stop above the swing highs on every down move. Anytime it makes a lower low, comes up, makes a lower low, comes up, makes a lower low, comes up, your stop's right here. And you can see as it's chopping around, you might have got stopped out right here around 20. You're short around 35. That's a 15 pip move on a relatively dead day. And if you see not a whole lot of intensity using our intensity tools, you probably want to get out of the trade with a 5 to 25 pip maximum profit, because that's the most you typically get on dead days. Now the dollar also had brief spurts of moderate strength and intense strength from 7 to 8:30. The pound was consistently the weakest. You could have also traded the pound dollar on the short side. Some of the best trades I see on here are anytime you see a multi-hour, very low volatility rectangle pattern or wedge type pattern. Those are pretty high probability trades, and you can see this one fell 40 pips. If you were short this and you saw
off again, buy level.
If you were short this and you saw it on a tick chart, it would have given you more confidence to hang into this. And this is one of those things where trailing your stops down above every swing high. As it makes a lower low and comes up, you move your stop right above that bar's high. Makes a slightly lower low and comes back up. So that always makes me a little nervous. If you're scalping, typically on the next wave down, you want to look to get out of that trade. Here's the high, here's the low. Notice it went right to the fib target. Wouldn't have been a bad place to get out, and then it moved back up 20 pips. You could have got it short again and rode that next wave down. And on a tick chart, notice it's coming up, pulls back, makes a slightly higher high. You can have the tiniest of losses when you use tick charts for precise entry. And on this last wave down, from, let's say it started right here, notice it went right to the previous day's low, the first fib target. You short this thing around 48, out of this trade right here around 18. It's a 30 pip move in a relatively dead day. And our FX Scalper Pro tools, which I'm working on a bunch of tools right now, so I have to share one of my accounts from home and work to get those tools working live. But as soon as I'm done with that, I'll leave it running overnight. You probably would have seen the FX Scalper Pro stay red the whole time and maybe went green again right here. I have left it on the charts now for the last 20 minutes or so. And what this does is it shows you the percentage of pound pairs going down on a very fast tick chart, and the percentage of dollar pairs getting stronger or weaker. And a lot of times when you run this, you'll see various swings up and down that look like the same magnitude, but you'll notice the FX Scalper Pro histogram showing a higher percentage of pound pairs going down on down moves than them going up on up moves, kind of like what you see right here. And you'll be able to kind of read the market in a way that you've never done before when you have that. In fact, a lot of times you'll see as the currencies are going up, let's say in this case right here, maybe 80-90% of the pound pairs are going up and dollar pairs getting weak. Very little amount of weakness showing up on this little pullback. So you go in, and if it goes up and makes a higher high and you don't see an equal number or percentage of pound pairs going up and dollar pairs getting weaker, in other words, the histogram on the bottom is showing a smaller number being plotted, usually that's going to be the end of the move. And it'll allow you to take 5, 10, 15 pip moves rather than have break evens. Plus it'll also set the stage for possible counter trend trades up near the high. If you see it going up with a smaller percentage of other pound pairs going up, maybe the pound's stronger than the dollar, but it's not stronger than other currencies, and usually that's a bad sign for being long the pound dollar. One of the easiest, ways of avoiding bad trades is using a simple tool that most people probably have heard of, but maybe don't use. Um, you can measure a trend by, the swings. An uptrend is a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows. So example, this pound dollar right here, you can see here was the low, here was the high, lower high, and it broke down, made a lower low, came back up. This high is lower than before, so it's still in a downtrend, right? Here we made a lower low, than before, so it's safe to assume that you're in a downtrend. But now it broke out over these highs, it rallied up, came back down. This is a higher high than here, here, and here. It's in an uptrend, and as long as the highs stay above, those swing highs, the trend is up. Previously, as long as the highs of any counter trend moves stayed below previous swing highs, the trend was down. Once it broke through those highs, the trend reversed, as you can see, and that happens over and over again. Like here we made a higher high, and then here we made a lower low than before. This high is obviously way less than that, and that was the beginning of this little multi-hour downtrend.